This video will help you complete the second discussion board post that you have to make with regards to Lockheed Martin. If you're looking for the location of the assignment, you can find it in two places. It's under the discussion board link right here, and you can find the link there, or you can go to the module, scroll down to module 2, and all the way to the bottom of that is a link to this discussion. So in this assignment, you want to first take these steps, open the Excel template, and get that, if you have two monitors, I think you'd find it very helpful. So what you'll do is watch this video on one monitor and then have this Excel template open on a second monitor so that you can watch me do it and then you can do it. And that way you can pause the video while you're working on it and then start it up again when you're ready for the next step. Alright, so then once you complete this template, there are sections of it that you're going to post into the discussion board and then make some comments on. So that's why you need to complete this Excel template and use the video to get that done. You got several questions that you're going to tackle and some hyperlinks to external sources that you can look at to help you learn what the various aspects of financial statement analysis relate to. So there's groups of ratios that we do to help us assess different aspects, different strengths and weaknesses of a company. That helps us make decisions about whether or not we think they're a strong performer and profitable and reasonable balance sheet position and ability to pay their bills on time and ability to collect their accounts receivable and turn their inventory, things of that nature you can pick up by doing financial statement ratio analysis. So you got 1, 2, 3, 4, 5 questions this time. It'll probably take you about, I would say about the same amount of time as the last time, depending on your comfortability or your ability in Excel. Absolutely, you can take these videos and you can speed them up if you're really good at Excel and you follow it quickly. Or if you need a little bit more time, I think you can even slow it down. So you can, I don't know how that'll sound, but you can slow down the video and watch me go through those steps. And of course, you always know if you need a little extra help with anything, I'm more than happy to do that, spend time with you one-on-one. So just let me know. Alright, so that's the assignment. I'll come back to this from time to time once we get towards the tail end of the Excel piece and help you figure out what you got to do to get this completed. So let's go to your Excel file. This is a template that's posted there, and let's take a peek around. So if you go to the beginning of it, it should open here on this page, because this is the page that I want you to complete. The rest of the pages are just backup information, so let's take a look. So what I gave you here is all the balance sheets for Lockheed Martin from 2014 to 2019. And you looked at the annual report last week, so I clued you in. Most publicly traded companies will post the results of their most recent year first, and then the older years will come to the right of that. And so that's exactly what Lockheed is doing. This is your 2019 balance sheet and all the way back to 2014. So this gives you a better sense for the trends that have occurred, and you need that information in order to be able to say if they're doing better, if they're doing worse. Without it, you're kind of like, well, this is how they're doing right now. I'm not really sure if they're doing better or worse. I need historical data, and I also need to know how they're doing relative to competitors to be able to judge them fairly, right? So another company within their industry would be helpful, which is why next week you're going to do the exact same thing we're doing right now, but you're going to do it for Boeing. So you'll get a chance to do this twice. And you'll get a chance to do this again when you get into the finance class, the Principles of Financial Management class. You'll do ratio analysis again. So I'm just kind of introducing the topics and getting you familiar with it so that when you get to finance, it's not the first time you've seen it. All right, here's your income statements. Again, I try to grab I got 5 years back here. I need one extra year on the balance sheet because we need to average some of the balance sheet items, and I'll talk more about that when we get to that part. But here's your income statement. And then your statement of cash flows, you're going to need only one item, one row on this report, because we haven't covered it yet. I don't want to get too in depth, but I just want you to keep peeking at it, keep looking at it, because the more familiar you are with it, the less trouble you'll have when you get to it in chapters 11 and 12. So notice, the most important thing right now is notice there's 3 sections: operating activities, investing activities, and financing activities. And every statement of cash flow is set up in that order. And then we looked at this in the first discussion. These cash balances you see at the very end should always tie back to cash balances, cash and cash equivalents balances back here on the balance sheet. And they do, right? So you can just double check those and eyeball them, and they do match up. So that's part of the point of this report, is to break down where those cash balances have come from during the year and what's made the cash balance go up and down. All right, so let's get started and take a look at this page. First, let's just kind of get a gander at what's going on here. You got 4 groups of ratios, and each group tells you something a little bit different. They're all important and all interesting in their own right. So this first group of ratios are called liquidity ratios. And what we're going to assess here is whether or not we feel the company has the ability to pay their bills in the short term. So it's a short-term liquidity. Liquidity means ability to convert these assets into cash quickly and have money to be able to run the business and make payroll and do those kinds of things. Right. So what you're going to see us do here is we're going to focus primarily on the balance sheet items up in the current asset and current liability section. So let me go over there real quick and just show you that. The balance sheets that you've done so far in solid footing have been real simple ones, and we didn't make any distinction between the types of assets, but eventually you need to be able to do that. And so that's another reason for this project, is to introduce you to that idea that we take our assets and we classify them based on the amount of time it takes to convert them into cash or their nearness to cash. So current assets, of course, should include cash, because these are the assets that we would expect to use, or churn is another word we use. We use them or churn them up, use them up within a year's time. So I expect to use this cash every day. And then the receivables, the idea here is, okay, we expect to collect that and turn that into cash every 30 days, let's say, which is very standard terms of payment. Most customers get 30 days to pay, unless there's special arrangements, which can happen. Contract assets for Lockheed Martin, there was a change in the generally accepted accounting principles. It's a little bit beyond the scope of this class. But just recognize that this has to do with the ways in which they're recognizing revenue, and they're booking these accruals. These are accruals that they just started doing because the revenue recognition principles changed when it came to contract sales. Again, beyond the scope of this class, if you like this kind of stuff, you should take the intermediate accounting class and consider majoring in accounting, which I'd be very happy to talk to anyone about. Inventories, obviously, we don't want to hold on to them. We want to sell them as fast as we can, and that's how we make our money. So we don't want to be sitting on large inventory items. We want to turn that quickly. And then there's always a group called Other for things that aren't very significant. We just group them together and throw them in that account. All right, and these are consolidated. Obviously, Lockheed Martin has probably hundreds of different cash accounts on the general ledger, but they're all consolidated here for external reporting purposes to let us focus on the big picture of what's going on with the company and not the little details. All right, then this other section for assets are what we refer to as our long-term assets. And the most important one that you're going to learn about in solid footing is the property, plant, and equipment section, which you got to in Chapter 7 when you book depreciation entries. So that's what net means here, net of depreciation expense, and net of accumulated depreciation, which is what's on the balance sheet. We haven't gotten into these intangible types of assets. Goodwill is an asset that occurs when a company buys another company and they pay more than the book value of their assets. I really should say the fair market value of their assets. So, and those are the assets that they can record. If you remember, I don't want to go too deep here because it's beyond the scope of this class. But if you remember in our discussion last time, the first discussion, I asked you to look at the market value of Lockheed Martin, and I asked you to calculate the implied assets in that. And then I asked you during our discussion, our weekly meeting, Zoom meeting, well, what other assets could it be that are causing this difference in the market value of assets to the book value of assets? So goodwill, we can write up the assets that are on the books to their fair market value. And then if we pay extra than that, because you know we're going to probably, given that a lot of assets are not booked on the accounting records, if we pay more than that, we set up an account called goodwill. So there are occasions in which the accounting records do actually reflect market value. And that's when you immediately buy that company and you set up that company and you consolidate the records within your records. So that's a whole other aspect of accounting, doing consolidations where you pull different companies together. They might be fully owned subsidiaries. They might be partially owned subsidiaries where you have a minority interest. There's all kinds of things for you to learn in this accounting world. All right. Again, taxes beyond the scope of our class. So this is the only one I'm going to ask you to work with. And we're working with inventories, receivables, and cash already. So I'm going to, focus most of our attention on those bigger items. In the current liabilities, you've worked with accounts payable. Here's your wages payable. This is current maturities of long-term debt. These are contract liabilities that relate to these contract assets. Again, beyond the scope of the class. So the ones I'm going to have you focus on mostly, accounts payable. And we'll look at other accruals. So this is your liabilities that you're going to pay in the next year. And these are long-term debts, including pensions that you owe your employees. And of course, you see some of these already from solid footing. Common stock, retained earnings are familiar to you, I should say, familiar to you. There's nothing in this account anyway, but it's another stock account that we use if we have par value. So again, beyond the scope of the class, I'll let you cover that in intermediate if you're interested. And then this is your comprehensive loss, which you notice is really eating up their equity. And if you look inside there, there's all kinds of strange transactions, again, beyond the scope of our class. And this just means that one of the subsidiaries that they don't own 100%. So there's a non-controlling interest that belongs to someone else, and you have to reflect that. Again, beyond the scope of the class. There's a lot to learn in accounting, and we're just, getting you started with the accounting system and how it all comes together. And that's really critical for business students to have that basic understanding. And then we get into more complex items if you choose to focus on accounting as your major. All right, so that's what liquidity is all about. We're going to assess the current assets and current liabilities section. So CA here means current assets, CL means current liability. So we'll do this section. It's real easy. If you do one, then you can do all of them. Let me show you what I mean. So I put equals in. So just hit the equal sign, and you go over to the balance sheet, and you click on the current assets here, and then you hit the divide on your keyboard, and then you hit on current liabilities. You just click it with your mouse, point and click at it. And then hit enter on the keyboard, or return, however your keyboard's set up. And that is the current ratio. And then you can just pull that across like this, because of the way I have these reports set up, where the years are just like the way I set up this report. So you can actually just pull that across, and it picks up the right cell, so it automatically moves. That's how Excel works. So essentially what this is saying is that they have $1.22 in assets relative to liabilities. And that's playing it pretty lean. You can see the highest amount they had was in 2017, and the lowest amount they had was last year in 2018. Okay, so they play their working capital, is what we call current assets and current liabilities. They play that pretty tight. It means they've got $1.22 last year in their pocket, in a sense, on hand, to pay for every $1 they owe in liabilities. So they have to time that right and make sure those bills that they have to pay aren't going to come due before that cash comes in. So they run their business very lean. All right, now this is a way for us to gain a little bit of insight, because oftentimes the current assets section of the balance sheet contains older, like, items that are going to take a long time to convert to cash. So for instance, this inventory, probably when we sell it, goes into receivables first, and then we get the cash, right? So the inventories take longer. They're less liquid. So we're going to actually focus on just how much liquid, really liquid, close 30 days of liquidity do we have. So when I do this next ratio, I'm only going to include cash and cash equivalents and the receivables and divide by current liabilities. So when you do this one, you hit equals and put in a parentheses so that we can add the current sections that we want. So that's the cash and cash equivalents and receivables. Close that up, then hit divide on your keyboard, and then hit the current liabilities for 2019, hit enter on the keyboard. All right, so that's showing us we only have 28 cents of immediate cash to pay our current liabilities. So their liquidity here is extremely tight. And if we tighten it up even one more step and we look at just the cash, so just this relative to what I owe, and it's really small. Okay, so this difference that you see in here is attributed to inventory and those other asset groups, which generally aren't converted to cash anyway. So we're looking only at the immediate receivables and the cash and cash equivalents that we can use to pay the liabilities, right? Because this one included all the current assets, which they're not all going to be available to pay the bills in time. So this is what we're trying to kind of comb out, is figure out, all right, well, if the bill was due tomorrow, do I have enough cash? So if I had to pay all my current liabilities tomorrow, would I be able to do that? The answer is no. You only have 28 cents on the dollar. Here, if you just look at cash and ignore the receivables, you say, oh, I got 11 cents on the dollar. So you need to tap some line of credit from the bank to be able to make this work. Now this one looks at cash flows from operating activities, which are cash flows that come about as a result of sales and expenses. So if you look at that, that one's right there. Cash provided by operating activities, and you divide that by the 2019 current liabilities. So you just hit divide and then click on that and then hit return. All right, so this is saying that I have about 52 cents in cash flows, which is a little better than this, right? But again, it's a timing issue. Are you going to be able to generate the cash in time to pay the bills? Certainly overall, you have enough current liquidity to cover your bills, but you might have some timing problems here. So I would say their liquidity position is a little bit weak. I would think they're going to have to tap the bank now and again, and they're going to incur interest expense. However, if they got a good deal with the bank and the interest is pretty low, then maybe it's worth running it pretty tight. All right, so now what I'm going to have you do is just take these and go to highlight them like that. Go to insert and go to that little drop down thing there for your charts, and then pick this line chart and let's move it over here. So that's just a line chart. I'm going to clean it up a little bit by putting on a title, and I'm going to label everything. So let's go to select data. So I right mouse click on the chart, I go to select data, and I want to rename these series. So series 1, I'll edit, is the current ratio. So you click edit, click this, and you click that, and hit enter. Say OK. So you see it replaced that. Now go to this one, hit edit, hit this little up arrow, click quick ratio. Enter. Okay. Click edit. Click this arrow. Cash ratio. Okay. Click edit. Click the arrow. Okay. So now we got the names of those on there. And then over here, what I'd like to do is edit those and include, let's see if I can just do it this way. Yeah, let's try that. Yes. Okay. So what it did is it put the years down in here. Yep. Alright, so what I did, I know maybe you couldn't see it from being behind there. If I hit edit again, and I hit this up arrow, and I just highlight those years like that, and then hit enter on my keyboard, say OK. Alright, so that's looking much better, right? We can give this chart a title, and I would call this liquidity ratios. And then, I enter on that. If I want to add some labels, which I think is always useful, I can right click on that, add data labels. There. So that's adding the amounts, and then you can do that for this one too. Add data labels, add data labels, add data labels. Alright, that's a good looking chart. That's going to be the first one. You're going to copy and paste that in. So you're not going to share any of these numbers. I want you to create these visuals. Now remember how this is, because the numbers ran from 2019 out. You're going to have to look at it from right to left in order to assess the trend. There's that bump in 2017 that caused us to have a stronger liquidity position, but then it deteriorated, right? And so we improved since last year, but it's still a pretty weak overall position. Honestly, I'd like to see them run that at least 1.5 at this level, at the current ratio level, at least 1.5. And then at the quick ratio level, which is the orange one, I'd like to see them run that about 1.2. So they're really a little bit below the benchmark that I would consider reasonable for a liquidity ratio. Okay, let's look at